Dear esteemed ladies and gentlemen, good evening, Your Excellencies. It's very difficult and intimidating to be speaking right after Lord O'Neill and the Governor, so I'm not sure how original I can be tonight. But I will try to offer a perspective from the banking, the supervised banking, and also the clients. I think if we are to ask the question, how possible is a crisis in the financial world after 2007 and 2008, I think I would draw a parallel with the car industry or the airplane industry. So every time you have an airplane crash, you try to find the ways to actually protect better the industry and avoid a future crash. But you cannot eliminate that. And the same happens with the cars. You can be a reckless driver, even if you do have regulation, and you still can run into a crash. So I think despite all the good effort, we cannot eliminate the possibility of risk and the possibility that we might indeed run into financial crisis again. I think another aspect that we have seen is that the current generation of business people, bankers, people operating in this world, they're not used, as Lord O'Neill said, in this environment that combines high costs, high interest rates, and all these challenges around employment, and the fact that you try to have a globalized world, but each country tries to become a little bit more introvert as well at the same time. So if we look at the 2007 crisis in the US, where we basically, the Americans lost about 9.8 trillion in wealth, which is a phenomenal number, I think we have to look at the sources of the problems back then. So what actually drove the crisis back then was that you had a very relaxed criteria of lending into mortgages, so the subprime lending, as we all know, which did, however, give a boost to the film industry, because we've seen I don't know how many movies around the crisis in the subprime lending. We had the housing market bubble. We had complex financial products which went hand in hand with very high risk-taking, excessive risk-taking by the banks at the time. And you had insufficient and inadequate regulation and weak risk management internally, by the banks, which, as the government said, did continue in present cases in some of the banks that we did see fail in the US recently. And clearly, you had the interconnection of financial markets and bank failures in the sense that, once you had the collapse of Lehman Brothers, that created a domino effect, a spiral effect into other markets, coupled with the weak intervention at the time of the regulators and the government. So what has happened since, and what we all of us, living in banks, and I'm sure all of you clients complain, is that we have seen increased regulation since then. So we have supervision. I think it's pretty clear from what has happened in Europe versus US that the regulatory system in Europe, with the several stress testing, is indeed quite rigorous, which avoided future collapse, as we have seen with some banks in the US. We have transparency and risk disclosures that are quite strong from the regulated financial institutions themselves. So we have market discipline, we have a banks management team that have strong governance now with several committees and a high-risk culture that help us avoid excessive risks. We do have resolution mechanisms as well that do help the institutions, the failing institutions, to happen in an orderly way, like the BRRD. But we also have an enhanced deposit scheme. Whilst this might be inadequate or imperfect, but it's still a good progress versus what we had about 15 years ago. And clearly, we have some stronger intervention in the fiscal and the monetary policies, in the sense that we have seen quantitative easing in the past. We have seen rescue packages. We've recently had, with the pandemic, a series of packages that help sustain the economy, but at the same time, give also banks capital relief measures that would help them to remain afloat. If we look at the recent banking crisis in March, I think it's a combination of things, as the government said, and Lord O'Neill. Effectively, we have seen this creation of inadequate measures, but also the fact that it was a unique bank run in Silicon Valley, in the sense that it happened online. We haven't seen the pictures of people rushing in the branches to get their deposits back. But equally, I think what we have seen is the fact that people say in the banking industry that a bank can close either by the regulator or the customer. And what we have seen in the US is that, further to that in Europe, is that sentiment was actually multiplied very quickly. This is one of the reasons why we have seen also the the problems that the distress in Credit Suisse, which again led to some distress in other European banks, like for instance Deutsche Bank, where we have seen people shorting the stock or affecting clearly their equity value in the market. To our relief, I think we have not seen such incidents in Greece, and I'm saying this coming from one institution that has been more or less fragile. I think during that week that when Credit Suisse was failing, we have seen a deposit inflow even in our bank, which shows that indeed the customers still believed, and therefore the sentiment did not take the extent which we have seen in other institutions in other countries. I think also, what we need to see is, both from a European bank perspective, but also from a Greek bank perspective, we have other inherent improvements that allow us to feel safer in the current world. So both European banks, but also, Greek banks now have returned to profitability. So both in 2022, but also, the Greek banks, after deleveraging with the non-performing loans, we have seen a return to profitability. Even though this might, you might still have threats to that, it's a sign that you return back to normality. Resilience, I think capital ratios across Europe stand quite in satisfactory levels. So I think the aggregate European average of CET1, the Common Equity Tier 1 ratio, is at 15.3 at the end of 2022, which is well above the minimum regulatory requirements. And the third and last but not least important is liquidity and funding. So the average liquidity coverage ratio in Europe exceeded 160% at the end of 2022, well above the American average. And again, the quality of deposits is also stickier in the sense that you have customer deposits with a good mix of both retail but also institutional clients as well. So therefore, I think that we cannot exclude the possibility of financial crisis, and I think we will always have to remain vigilant. However, I think we all feel a lot safer, and we all feel that we have the right governance in place, the right disclosure, but also quite robust regulatory system to ensure that we can weather any future crisis that might happen. So I think I've been briefer than what I was expecting, but I didn't want to repeat much of what was said previously. So thank you.